Most people believe the first $10,000 is built in the stock market. They imagine it begins with the perfect investment, the perfect strategy, or the perfect moment to buy. But for most working people, that is not where the story begins. The first $10,000 is built much earlier than that. It is built in the quiet space between income and survival, between what you earn and what life slowly takes away from you every month. Because before money can grow, it first has to stay. And for millions of people, that is the hardest part. You already know how this feels. Payday arrives. Your bank account finally looks healthy again. For a brief moment, everything feels under control. You begin thinking, maybe this will be the month things finally change. Maybe this is the month you finally get ahead. Maybe this is the month you keep more of the money you worked so hard to earn. But then life begins collecting its share. Rent comes first, then the credit card payment, then the car payment, fuel, groceries, insurance, utilities, phone bills, subscriptions you barely remember signing up for, small purchases that did not seem important at the time. And slowly, quietly, the number in your account begins shrinking again. By the time the next week arrives, your balance may already be fragile. Maybe $100, maybe $50, sometimes less. A number so small that one ordinary problem can destroy the rest of your month. That is why saving your first $10,000 feels almost impossible. Not because you are lazy, not because you lack discipline, and not because you need another motivational speech. It feels impossible because most working people are trying to build stability inside a financial system that constantly pulls them back towards zero. When you have no savings, life becomes aggressive. A flat tire is not just a flat tire, it becomes a financial emergency. A medical bill is not just paperwork. It becomes panic. A broken phone, a missed week of work, or an unexpected repair can throw your entire month into chaos. Every inconvenience arrives with the same stressful question: how am I supposed to pay for this? People with financial margin often forget this reality. They see savings as just a number sitting quietly in a bank account. But that is not what savings really are. Your first $10,000 is not idle money. It is protection. It is breathing room. It is emotional stability. Two people may look almost identical from the outside. They might drive similar cars, live in similar apartments, wear similar clothes. But internally, their lives feel completely different. One person hears bad news and immediately feels fear. The other person still feels stress, but not immediate collapse. And that difference quietly changes every decision you make. When your finances are fragile, you begin making survival decisions. You delay repairs. You accept unhealthy work environments. You stay in situations longer than you should because instability feels more dangerous than discomfort. But when you finally build a financial buffer, something important changes. You gain time. You gain space. And those two things improve the quality of your decisions. This is why the first $10,000 matters more than most people realize. It does not immediately change your lifestyle. It changes your relationship with uncertainty. Instead of reacting to every problem with panic, you finally have room to think. Now, here is something interesting. Many of the world's most successful investors talk about this same idea, including Warren Buffett. Buffett is often known for his investment strategies, but the foundation of his philosophy is surprisingly simple. Protect your capital, avoid unnecessary losses, and allow time to do the rest. Before money compounds, it must survive. Before wealth grows, capital must stay in your life long enough to work.
This is something many people overlook.
They focus on investing before they build stability. They chase stocks, crypto, or trading strategies while their financial foundation is still fragile. But investing without stability is like building a house on sand. The structure cannot survive unexpected pressure, and that is exactly why the first $10,000 matters so much. Because it creates the first real layer of financial protection in your life. It gives your money time to exist, time to grow, time to begin working for you instead of disappearing immediately. And yet, for millions of people, this first step feels painfully far away, not because they do not try, but because their financial system is constantly working against them. Which brings us to the real question. If the first $10,000 is so important, why is it so difficult to build? The answer is not just discipline. The answer is structure. There are specific traps that quietly keep people stuck. Traps that drain income before savings ever have a chance to exist. And once you see these traps clearly, you begin to understand something powerful. The problem is not always effort. Often, the problem is the system itself. And in the next section, we are going to look at the first trap that makes building the first $10,000 so difficult. The first trap is something I call the survival break-even trap. This is the point where your income is just high enough to keep your life functioning, but not high enough to make you safer. From the outside, everything appears normal. You have a job, you pay your bills, you show up every week and do what responsible adults are supposed to do. But underneath that surface, the math of your life is extremely fragile. Your entire financial system is balanced on a thin edge. There is no margin. There is no real buffer. There is no distance between a normal month and a bad month. And when your financial life works like this, saving money becomes incredibly difficult. Not because you lack discipline, but because your system leaves no room for error. Imagine someone spends 3 months being extremely careful. They cook more meals at home. They avoid unnecessary purchases. They delay things they wanted to buy. After 90 days of discipline, they finally managed to save $800. For the first time in a long time, they feel a small sense of relief. Then life does what life always does. The car needs repairs. Insurance increases, a medical expense appears, or they miss a few days of work and suddenly, 3 months of effort disappear in a single week. Not because they were irresponsible, but because their system was fragile. This is the hidden problem with financial fragility. Small problems become expensive problems, and expensive problems reset your progress. This idea connects closely with something Warren Buffett often talks about in investing: the concept of margin of safety. In investing, margin of safety means buying assets at a price that protects you from mistakes. But the same idea applies to personal finance. Your life also needs margin. Margin between income and expenses. Margin between survival and stability. Without margin, every unexpected shock becomes destructive. And that is why the first $10,000 matters, because it creates the first real margin in your life. Now let's talk about the second trap, the trap of pressure spending. Modern life constantly pushes people to look successful, to look stable, to look like they are doing well, even when their finances are not ready. And sometimes, people spend money not to improve their lives, but to protect their identity. Someone earning $3,000 a month finances a $1,200 phone. Someone keeps an expensive car payment because it feels like proof that they are successful. Someone exhausted after work orders delivery food every night because it is the only moment of comfort during the week. None of these decisions look destructive on their own. A phone upgrade does not seem dangerous. Ordering food once does not seem dangerous. Buying something nice after a stressful week does not seem dangerous. But repetition slowly creates pressure. Small comforts become habits. Habits become lifestyle. Lifestyle becomes financial strain. And slowly, the money that could have become protection disappears. This is not about blaming people. It is about understanding psychology. When people feel behind financially, they often spend to protect their self-image. They want to feel normal. They want to feel like they are not falling behind. But building financial stability often requires something uncomfortable, a season of simplicity, a season where life may look less impressive while it becomes more stable. Now let's talk about the third trap, the trap of cognitive exhaustion. People often imagine financial success as a pure discipline problem.
They think progress comes from tracking every dollar, reading every financial article, optimizing every expense, and making perfect decisions every day. But real life is exhausting. People wake up early, they commute, they work long hours, they deal with stress and responsibilities, and by the time the evening arrives, their mental energy is already gone. When the brain is tired, it looks for relief. It looks for convenience. And convenience is often expensive. Takeout instead of cooking, subscriptions instead of effort, ignoring bills instead of reviewing them, scrolling instead of planning. None of these choices feel dramatic, but together, they quietly drain financial progress. This is where financial struggle becomes more than a money problem. It becomes a bandwidth problem. Your mental energy is spent just trying to survive the day, and the part of your mind that was supposed to plan the future never gets enough attention. Over time, this creates a cycle. Financial stress creates mental exhaustion. Mental exhaustion creates expensive decisions, and those decisions create more financial stress. The cycle repeats again and again. Understanding these traps is important because it changes the way we think about the problem. Saving money is not only about discipline. It is about designing a system that works even when life is stressful, even when you are tired, even when things are not perfect. And once you begin designing your financial life with that idea in mind, saving your first $10,000 becomes far more realistic. Because instead of fighting against the system, you begin building a system that finally works for you. And once that system begins working, the path toward real financial stability becomes much clearer. In the next section, we are going to talk about what actually helps someone build their first $10,000 in the real world. Not just theory, not just motivation, but practical changes that slowly transform financial fragility into financial stability. Now that we understand the traps that quietly keep people stuck, the next question becomes much more practical. What actually helps someone build their first $10,000? Not in theory, not in perfect conditions, but in real life. For most people, the process usually begins with 4 important shifts. The first shift is stopping the financial leaks. Before you focus on earning more, you have to reduce the money that quietly disappears. Many people underestimate how much money leaks out of their lives through small recurring expenses. Subscriptions that were forgotten, services that are rarely used, convenience spending that became automatic, late fees, interest payments, small costs that feel harmless individually, but become expensive through repetition. Imagine trying to fill a bucket that has holes in the bottom. No matter how much water you pour in, it will never stay. Financial leaks work the same way. Before savings can grow, the leaks must slow down.
The second shift is building a starter buffer. Many people fail because they focus only on the final goal. $10,000 feels far away, and when a goal feels too far, people lose motivation before the process even begins. A smarter approach is building the first layer first. $500, $1,000, one paycheck saved. This small buffer immediately changes your life, because small emergencies stop destroying your entire month. A car repair no longer requires borrowing. A surprise bill no longer creates panic. Your financial system becomes slightly stronger. And once that stability exists, saving the next 1,000 becomes easier. The third shift is increasing earning power. There is a limit to how much you can reduce spending. Eventually, the real breakthrough must come from income. But increasing income does not mean chasing random side hustles. It means improving the value of your time, learning a stronger skill, moving into better-paying roles, negotiating your salary, changing companies when your market value increases. Warren Buffett often says that the best investment you can make is in yourself, because when your knowledge improves, your earning power improves. And unlike many investments, that return stays with you for life. The fourth shift is protecting progress. This is where many people lose momentum. They begin saving money, they feel proud of their progress, and slowly, their spending expands again. A nicer apartment, a more expensive car, more convenience spending, more lifestyle upgrades, and suddenly the extra money disappears. Financial progress requires protecting gains from lifestyle inflation. When income increases, a portion of that increase must be captured, saved, protected. Otherwise, the system resets. This is where automation becomes powerful.
When savings happen automatically, progress continues even during busy or stressful months. A small transfer every payday. Money moving into savings before it can be spent. A system that works quietly in the background. Because real financial systems should not depend on constant motivation. They should work even when life becomes busy, even when your energy is low, even when your attention is somewhere else. Another idea Warren Buffett often emphasizes is patience. People often underestimate how powerful time can be. They want fast results, fast profits, fast success. But financial stability rarely appears quickly. The first $1,000 may take months. The first 10,000 may take years. But something interesting happens once the system starts working. Progress accelerates because savings create opportunities. Opportunities create growth, and growth creates momentum. At this point, something important begins to change. Money stops behaving like sand slipping through your hands. Instead,
It begins behaving like structure. Your financial life becomes stronger, your decisions become calmer. Your future begins to feel more predictable. This is the hidden transition between survival and stability. At first, you are fighting to keep money from disappearing. Later, money begins helping you. And that transition often begins with the first $10,000. Not because it is a magical number, but because it represents the first real structure in your financial life. It means emergencies no longer control every decision. It means opportunities can finally be considered. It means your future begins to feel possible instead of fragile. This is also why patience matters so much. Many people quit the process too early. They save for a few months, something unexpected happens, progress disappears, and they feel like the effort was pointless. But setbacks are part of the journey. Even successful investors experience difficult periods. Even Warren Buffett experienced years where investments underperformed. But long-term success belongs to people who continue building the system, saving,
protecting, improving their earning power, and allowing time to do its work. Because wealth rarely appears suddenly. It grows slowly, then suddenly feels obvious. And the moment it begins is usually much quieter than people expect. It begins with small decisions, small savings, small habits repeated consistently, until one day, the number that once felt impossible is sitting there in front of you. $10,000. Not luxury, not status, not a dramatic transformation, but something incredibly powerful. Stability. A small shield between you and chaos. And once that shield exists, the rest of the financial journey becomes much easier. Because now, for the first time, your money has the chance to stay. And once money stays, it finally has the chance to grow. At this point, something interesting begins to happen. Once someone builds their first real financial buffer, their relationship with money begins to change. Not overnight, not dramatically, but slowly and quietly. The constant pressure begins to fade. The fear that every small problem will destroy the month begins to weaken. And when that fear starts disappearing, people begin thinking differently. Instead of asking, "How do I survive this week?" they begin asking, "How do I make next year better?" This shift may seem small, but it is incredibly powerful. Because long-term thinking is where real financial progress begins. And this is exactly the mindset Warren Buffett has followed throughout his life. Buffett did not become wealthy by chasing quick profits. He became wealthy by thinking long-term, very long-term. When he was a teenager, he was already saving money from small jobs, delivering newspapers, selling items, looking for small opportunities to earn and save. Not because he needed to be rich immediately, but because he understood something very important. Money that is saved early has more time to grow, and time is the most powerful force in finance. Buffett often explains that his wealth did not come from extraordinary intelligence. It came from patience and time. Because when money is allowed to compound for decades, the results become extraordinary. Compounding is one of the most powerful forces in the financial world, but it is also one of the most misunderstood. In the beginning, compounding feels slow, sometimes painfully slow. Your savings grow a little each year. The numbers seem small. The progress feels invisible. But something important is happening beneath the surface. Your money is beginning to work. At first, you are working for money. Later, money begins working for you. And the longer that process continues, the more powerful it becomes.
For example, if someone invests consistently for many years, their returns begin generating additional returns. Those returns create even more growth, and eventually, the system begins accelerating on its own. This is why Warren Buffett often emphasizes starting early and staying patient. Because time multiplies money in ways that are difficult to imagine at first. But there is something very important many people overlook. Compounding only works when money stays invested. If savings constantly disappear because of emergencies, compounding never has time to work. This brings us back to the importance of the first $10,000, because that first buffer protects your financial system. It protects you from having to sell investments during emergencies. It protects you from using high-interest debt, and it protects your mental state when unexpected problems appear. Financial stress changes the way people think. When someone is constantly worried about money, their thinking becomes short-term. They focus only on the next bill, the next payment, the next problem. Long-term thinking becomes almost impossible. But once a financial cushion exists,
something changes inside the mind. People begin thinking differently. They begin planning further ahead. They begin looking for opportunities instead of simply reacting to problems. And this is where real financial growth begins. Because wealth is rarely created by one big decision. It is created by thousands of small decisions repeated consistently. Saving a little each month, improving your earning power, avoiding unnecessary debt, investing patiently, allowing time to do the rest. None of these actions are dramatic. None of them look exciting on social media. But together, they create something powerful: financial momentum. And momentum changes everything. Because once momentum exists, progress becomes easier. Savings grow, opportunities increase, confidence improves, and the system begins strengthening itself. This is why the first $10,000 matters so much. It is the moment where the direction of your financial life begins changing. Before that point, money often feels temporary. It arrives and then disappears. After that point, money begins staying. And once money begins staying, the future begins opening. You can start investing. You can start planning long-term goals. You can start thinking about financial independence instead of constant survival. This is the quiet turning point many people never notice. It does not feel dramatic. It does not feel glamorous. But it changes the trajectory of a person's life. Because now, instead of constantly repairing financial damage, you are finally building something: a system, a foundation, a future. And all of it begins with something that once felt impossible: your first $10,000. Not luxury, not status, not wealth, but stability. A small layer of protection between you and chaos.
And once that protection exists, the rest of the journey becomes possible. Once someone reaches their first $10,000, a new question usually appears. What comes next? Because the first $10,000 is not the finish line, it is the starting point. It is the moment where financial survival begins turning into financial strategy. This is where investing begins to make sense, not as a gamble, not as a desperate attempt to get rich quickly, but as a system for long-term growth. Warren Buffett has always been very clear about one thing. Investing is not about excitement. It is about patience. Many people imagine investing as constant action, buying, selling, watching the market every day, trying to predict what will happen next. But Buffett's philosophy is almost the opposite. His strategy is based on a very simple idea: buy strong assets, hold them for a long time, and allow compounding to do the heavy work. Buffett once explained that the stock market is a device for transferring money from the impatient to the patient. That sentence alone explains a large part of how wealth is created in financial markets. Because most people want fast results. They want quick profits. They want immediate success. But the market rewards patience far more than speed. When someone invests consistently for many years, their money begins growing in layers. The original savings grow. The returns from those savings grow. And the returns from those returns begin growing as well. This process may appear slow in the beginning, but over time it becomes incredibly powerful. Imagine someone investing a small amount every month for many years. At first, the progress seems tiny. The numbers barely move. But after enough time passes, the growth begins accelerating. This is the real power of compounding. And it is one of the main reasons Warren Buffett became one of the wealthiest investors in history. Not because he chased quick profits, but because he allowed compounding to work for decades. However, there is something very important to understand. Compounding requires two things: time and consistency. Without time, growth cannot accelerate. Without consistency, the system cannot continue. This is why Buffett has always encouraged investors to focus on long-term thinking rather than short-term speculation. Another important lesson from Buffett is simplicity. Many people believe successful investing must be complicated. They imagine complex strategies and constant market analysis. But Buffett often recommends something much simpler. Invest in strong businesses. Hold them for long periods. Avoid unnecessary trading and allow time to do the rest. This approach may sound boring, but boring strategies often outperform exciting ones, because excitement usually leads to emotional decisions, and emotional decisions often lead to losses. One of Buffett's most famous principles is protecting capital. He often repeats a simple rule. Rule number 1, do not lose money.
Rule number 2, never forget rule number 1.
This principle applies not only to investing, but to personal finance as well. Protecting your financial foundation is always the first priority, because once money is lost, recovering it becomes much harder. For example, if someone loses 50% of their money, they do not need a 50% gain to recover. They need a 100% gain. And that is much harder to achieve. This is why building a strong financial base before investing is so important. Once someone has a stable emergency buffer, steady income, and controlled spending, their investments finally have time to grow without interruption. And over long periods of time, that growth can become remarkable. $10,000 becomes $20,000, $20,000 becomes $50,000, and eventually, $100,000 becomes possible. Not through luck, not through gambling, but through discipline and time. This is the quiet process that creates real wealth. And the most interesting part is that it rarely looks impressive in the beginning. There are no dramatic moments, no sudden transformations, just steady progress, small investments, small improvements, small decisions repeated over many years, until one day, the numbers begin looking very different. What once felt impossible begins feeling normal. The person who once struggled to save their first $1,000 now watches their investments grow each year. The stress that once controlled every financial decision begins disappearing. And that is the real power of financial stability. It changes the way people think. It changes the opportunities they see. It changes the freedom they experience. All because they took the first step. They built their first $10,000. That first step created structure. Structure created momentum. Momentum created growth. And growth created possibilities that once seemed unreachable. So if your first $10,000 still feels far away, remember this. You are not just saving money. You are building the foundation that everything else will stand on. Because once that foundation exists, the rest of the journey becomes much easier. And one day, the number that once felt impossible will simply be the beginning of a much larger story.